Well, good afternoon, and I'd like to welcome everyone to part two of transferring your closely held family-owned business. I hope everyone was able to attend part one, which is on June 11th, I'm sorry. Just a few housekeeping matters before we get into the presentation. Scott and I would welcome any questions that you have throughout the presentation. Yeah, they can be submitted by using your chat feature, and we will address as many questions as we can at the end of the program. If we don't address them all, we will address them by email. The webinar will be recorded and available on our website on Friday, along with copies of all the slides. And you should all receive a follow-up email directing you to the webpage. You can feel free to share the audio and slides with others in your organization. Today's focus will be a little different than part one, which focused on transferring your business to family members and insiders. Scott and I will talk about preparing your business for sale for really going to market for strategic and financial buyers. Primary reason people do that is that realistically, if they need or want to get the highest and best price, that's typically the marketplace they go. Initially, before we get into that, I just wanted to talk a little bit about what the timing looks like, because that is a big question on a lot of people's minds. Should I go to market now? Should I wait? I'll give you a little bit of a pre-COVID and post-COVID analysis because they do tie together. But if we look back at the last 10 years, right up to the end of 2019, we have had probably the best M&A market we've had in a long, long time. It's been a great time to be a seller until about February or March of 2020. But going into 2020, the private equity and strategic buyers were paying very high multiples, paying a lot of cash for companies. The private equity market is sitting on probably over $1 trillion of cash that they would like to redeploy into companies. And most private equity firms now have morphed into 2 or 3 funds, maybe 4 funds. There's been a significant amount of competition between both private equity and strategic buyers for deals, which really has driven up the prices. Similarly, strategic buyers have really been in the same boat. They've got, roughly $1.6 trillion of cash or more on their balance sheets. There's been pretty low organic rate or growth rates, and which has driven them into the marketplace. And historically, strategic buyers have been maybe the highest bidders on deals. Although again, in the last 4 or 5 years, financial buyers, private equity have really evened out the playing field. So really, when you take a look at it, what has really fueled, the hot marketplace for sellers? Well, I mean, it's been primarily fueled by low interest rates and a lot of available capital. There are a number of banks and alternative debt providers that were literally fighting over, basically buyers trying to borrow money to them. And lenders literally were looking for high quality buyers. And if we take a look at rates, when 2008, 2009 hit, the Fed dropped rates to almost zero. And if we look at it from a historical perspective, they did not raise rates until December of 2015, seven years later. So we've now experienced really the same phenomena. Rates have been pretty much reduced to zero. And at least the Fed initially said they're not going to really re-examine the rates until the end of 2021. But I think we will see low rates still for the next 3, 4, 5 years. So again, when you look at basically what's been paid over the last 5, 10 years, there's been record-setting prices paid to sellers. The multiples have been extremely high. They're basically where they were back in 2006, 2007, right before the world crashed but the valuations have been, you know, really pushed high because of the high amounts of debt buyers have been able to get. There's a significant amount of undeployed private capital. And really there's a shortage, or historically, there's been a shortage of quality sellers or quality companies out there. Today, there are still far more buyers than there are sellers. And that's really created a lot of competition between financial and strategic buyers. And not to be overlooked, I think sellers too have actually lobbied and pushed hard to get high prices because, you know, once they get their company sold, their opportunities to get a high rate of return when they redeploy their money has been pretty limited. I mean, most people who did not want to take risk are settling for, you know, 4% rates on their money, which again has created a need for them to get the highest and best price they possibly can. So if we fast forward to today, or to, you know, 2020, we all have to acknowledge that COVID-19 has created an economic downturn different from probably any recession in recent memory. But at the same time, we still have a huge amount of people that are actually retiring, and that translates into a lot of owners that are really looking at transitioning out of their company. But here's where the disconnect is going to start. I think that buyers and sellers today are going to calculate values slightly different. I mean, we all know that you know, values when you sell a company are really driven primarily by the cash flows. And right now, sellers are saying, look, we know, well, not all, not universally, but many will know their 2020 financial statements are not going to be as good as 2019 or 18. So they're going to lobby and say, look, this global pandemic really fits the definition of a one-time, unusual, non-recurring event. So when you come to calculating cash flow, you've got to add back our income loss in 2020 because it's an unusual event. I think buyers, on the other hand, are going to look at it and say, well, maybe, maybe not. We're looking at 2020 kind of like we looked at 2008 and 9. You know, how well does your company perform in difficult times? Because 2020 is going to be the ultimate stress test to see how well, to see really how recession-proof your company is. So I think, I mean, people will look at that differently. The other thing that's going to be different is going to be the leverage or the amount of debt buyers can borrow. I think obviously lenders are going to be less aggressive in this environment. They're not going to offer the high leverage debt they once offered. And private equity and strategic buyers are going to have to look at other alternatives. And I visited actually with a few private equity firms on a deal I actually just finished. And they were indicating that if they found the right deal, they would consider fully funding it with equity and recapitalizing, going back to the bank a year or two later and pulling their money out and leveraging it up. So I think you're going to see a lot of people look at different alternatives because, you know, you could see in the past companies that might sell for, you know, 11, 12 times EBITDA, and they could borrow 7 times EBITDA to get the deal done. Well, today that the ability to leverage a deal like that up to that point is going to be non-existent. So I think we are going to see valuations decrease a little bit because of the disconnect in how you calculate cash flow and really how much leverage is involved. But there's one other concern that a lot of sellers are having in timing, and that is, you know, how long will there be, you know, window for sellers to get the highest and best price? There are people that are saying, you know, in a 5 to 7 year range, we're going to see maybe more sellers in the market than buyers. Right now, probably 70% of all closely held companies are owned by people over 55. People have held on to their companies a long, long time, longer than normal. And, you know, basically the concern is that if they all go to market or there's a big group that goes to market, there may be more sellers and buyers, and that may reduce multiples, in and of itself. But I wanted to leave you with a few final thoughts on just timing. According to a recent Wall Street Journal article, the value of announced mergers and acquisitions globally for the first quarter, is really down 33% from a year ago to about $572 billion. And this really actually is a 7-year low. In the US, the decline was actually sharper. It's down more than 50%. So I think people are getting to a point where they're expecting values to be lower, especially in 2020. But there could be some opportunity, as Scott may mention. When you look at preparing a company for sale, typically sellers can spend anywhere from 6 months to 2 years in preparing their company to go to market. So this may actually be a very opportune time to start the process. And just personally on timing, I'm a little bit more optimistic than probably the average person. I do really feel that we are going to see some third and fourth quarter activity, because as we reduce uncertainty, I think that'll help the marketplace. And eventually, when everything settles down, we're going to be able to see sports, concerts, and actually probably work on M&A deals. So that's, Scott, I'll turn it over to you.
Thanks, Steve. So the rest of the time, what we're going to talk about is really preparing the business for the sale. And I'm just going to make a few general comments first. One is the timing is really important on this preparation. It's never really too early to start, even if you're not going to sell your company or don't plan on it in the next year or two. Getting these things in place is only going to help the value of the company, and it's going to put you in a position that when you are ready to sell, you're going to be in a strong position, and you're going to maximize the purchase price. If you wait till the last minute, or you wait till you're close to ready to sell, you're not going to be able to do some of these things. It's not going to be as flexible. You're not going to have as much tax planning time or tax planning strategies in there. And so earlier is better. That's one of my general points. And all of us in this area have had people come to us after they have a signed letter of intent and say, okay, what can I do now? And the answer is not a whole lot. You're pretty far down the road, and some of these things take some time to plan. So don't wait till the end. The second general point is, no matter what, you have to consider who the buyer is. It might be a family member, it might be an insider with the business, or it might be somebody outside. That's who Steve's talked about, venture capital or other private equity. So that all those are going to be very different situations, but from this planning standpoint and preparing the business for sale, this will apply to all of those situations. And then lastly, just as a general comment, buyers one of the things they're always looking to do is reduce the purchase price or come up with reasons in the negotiation to reduce the purchase price. And that can be either before the agreement is signed or after the agreement is signed, when they're going through the due diligence process. So don't give them a reason to reduce the purchase price. Get these things in place, and then you'll be in a stronger position to negotiate. So I'm gonna talk through some of these issues. Steve's gonna go a little deeper into some of these when he gets to his presentation. But the first topic is what we call corporate hygiene, and that's to make sure everything is in place as it should be. And the first bullet point is ownership documents. And you might look at that and think, well, that's pretty straightforward. That shouldn't be an issue. But you would be surprised when we look at some companies, and for corporations, you have stock certificates. For LLCs, you have operating agreements. For partnerships, you have partnership agreements. I've come across several LLCs in my time where they don't even have an operating agreement. So there is no documentation as to who the owner is. And I had a situation a couple of years ago with a corporation who was ready to sell. They already had their letter of intent. And the owner said, oh, by the way, this key employee owns 5%. Well, the corporate records don't reflect that. They never issued any stocks certificate to this person, and they never treated him as an owner. So it's a little tricky to start moving ownership around at the last second. You get into all sorts of issues, tax from a tax standpoint and otherwise. Next is the corporate minute book. And again, in my experience, a lot of people overlook this. They don't pay much attention to it. They form their corporation, they issue their stock certificate, they put it on the shelf, and they don't touch it for 10 or 20 years. And this is also an important thing. The proposed buyer or purchaser is going to look at the corporate records. They're going to look at a minute book. You should have annual consents, at least, authorizing your actions. You should have stock certificates and transfers all proper and up to date. And that's, again, something, it looks better from the purchaser standpoint. It shows that you're keeping good records and you're running the company the right way. As an aside, it's important for other reasons as well. We've had audits where the IRS wants to look at the corporate minute book. They want to see if the salaries and the distributions were authorized. And it's, one of the reasons you have the corporation to begin with is to protect you from liability. And part of the protection from a liability standpoint is to run your business like a corporation and follow the corporate formalities. Well, this is one of those formalities. So if you don't do any of this, it doesn't mean that you're exposing yourself to all the personal liability, but it does crack the door open just a little bit for someone to try to make that argument. So that's second, you want to keep that up to date. Intellectual property, so patents, trademarks, licenses, you want to make sure that these are all in order and that they're up to date. Many companies have significant value tied up in their intellectual property, and you'll often would see, I would say that the two things that are most common problems when someone's selling a business that caused the deal to fall through is not having your intellectual property protected, or accounting issues, which I'll get to in a little bit. Next is business licensing and registration compliance. So again, you want to make sure those are all up to date and your licenses are properly issued and compliant. Review leases or prepare leases. You want to make sure your lease is in place and is solid. Your buyer doesn't want to have to worry about moving out of the property the minute they move in. So a lot of times, again, you'll see people who have a lease. It's a 5-year lease. At the end of 5 years, they don't do anything. They just continue paying the rent. So they're essentially on a month to month, and you don't want that. The buyer would prefer not to have something like that. And it becomes even more of an issue sometimes when you own the real estate. A lot of companies, a lot of business owners, you own your real estate that you're using to operate the business. And the question is, first of all, how do you own that? Is it in a separate entity or is it in the same entity that runs the business? And you would much prefer to have that in a separate entity for two reasons. One, from a liability standpoint, you don't want your corporate assets exposed to the liability from the real estate, and you don't want your real estate exposed to the liability from the corporation. So we try to generally segregate those assets. If you haven't done that, you want to look at trying to do that. Again, number one, from a liability standpoint, but also from a sales standpoint. So when you have a buyer who is coming in and looking at it, they may not have any interest in the real estate. They may just want the corporation. Or you may not have any interest in selling the real estate. You may want to keep that in place to provide you with cash flow and an income stream after you sell the company. So you want them in separate entities. But going back to the lease question, it's really important if you have related entities that the lease is in place, because you want that to continue on after you sell the company so that they are obligated to stay in that property, and so that you have this ongoing cash flow. Other reasons for having that lease, aside from preparing your business for sale, and one has come up very recently with the PPP loans, where I'm sure many of the business owners on this webinar have gotten funds through the PPP money, and you can use it to pay rent, but you have to have a lease in place, and you can't create the lease yesterday. The government is on to that. So another reason that you always want to have that in place. And then an additional reason is just from a tax standpoint, and this comes up also for the qualified business income tax deduction or the 199A deduction. Those leases have to be in place, and they have to be a certain type of lease. So if you're in that situation, you may want to look at that lease and make sure it's satisfactory and sufficient so that you can get that deduction for the rent, if that's possible. Continuing on with the corporate hygiene and employee agreements, one of the biggest concerns and the risks to buyers are that the key employees are going to depart after the new owner comes in, and so And on top of that, if you look down to the next, non-competes and non-solicitations, that they might take customers or clients with them. So it's important to have employment agreements in place, especially for your key employees and for the management team. The non-competes, again, the business from a sales standpoint is much more valuable if these are in place and if the employees cannot take customers or clients with them, or that they even can't go compete and work for one of your competitors. So those are important and they add value to the business if you have those in place. One, as an aside on the non-competes, there is an issue when the owner himself or herself has a non-compete, and the buyers in most cases are going to want that when they purchase the company. They don't want you the day after you sell your company to go to a competitor or to start your own company and use all your relationships and contacts to compete with them. So they're always going to want you to have something like that in place. The question is whether you want that in place prior to the time that you sell the company, as you're going through this process of preparing the business for sale. And I would suggest from the owner standpoint, you don't necessarily want those in place. And that's more of a tax issue. When you sell a business, you allocate the purchase price among different assets. You allocate it among the goodwill, you allocate it among certain fixed assets. And how you allocate the purchase price affects how the owner, the seller, is treated from a tax standpoint, and also how the purchaser is treated from a tax standpoint. If you as the owner have specific contacts and relationships that are important to the value of the business, that can be considered personal goodwill. That's called personal goodwill. Personal goodwill, you can allocate some of the purchase price to the personal goodwill if you have those relationships and that information. And the personal goodwill is taxed at capital gains rates as a general rule, and it's amortized by the buyer. So that can be better than someone who's buying assets. It can be better for both sides, in fact, in some cases. If you as the owner have a non-compete in place prior to the closing, prior to when you sell the business, then the personal goodwill belongs to the company. And so then from a tax standpoint, you can't allocate any of that purchase price to personal goodwill. So although we want the non-competes in place for key employees, we don't necessarily want them in place for the owner until we actually close. Confidentiality agreements, again, we want to make sure we protect the company's confidential information and trade secrets. Some of that is protected by law, but you want to have that in writing and to have the most protection possible. Deferred compensation agreements, you want to make sure these are properly documented. You want to make sure they're not in violation of any tax laws. There are many agreements in my experience out there from a deferred compensation standpoint that are in violation of Code Section 409A. That's the section that deals with deferred compensation issues, and it's very technical. So often we have seen companies that have those in place and they're in violation of that. Obviously, the buyer doesn't want to see that. And so that's something that may be worth looking at. They also don't want to get into disputes with employees after the closing because the deferred compensation agreements weren't properly documented. Employee manuals, every company should have an employee manual in place. It helps avoid disputes and claims with employees. It sets forth your policies and your rules and all the obligations of the employees and of the company. So those should be in place for everyone, but certainly if you're preparing the business for sale. Buy-sell agreements. Sally Grossman talked about this a lot. If you were at the first webinar, she talked about this quite a bit from a planning standpoint. So I'm just going to make a few comments. One is that there may be restrictions in the buy-sell agreement that need to be waived. So you need to review that. You might need consent of certain shareholders. You want to see if you have in the buy-sell agreement what are referred to as drag-along rights. And that basically says that if you have a minority shareholder who doesn't want to sell his shares, you can drag that person along and force them to sell. And then is there a right of first refusal for other shareholders? If it's not 100% owned, or if there is some individual who doesn't want to sell shares, do you have to offer that person the right to purchase the company before you sell it to the third party? So you need to review the agreement as you're going through this process, but also make sure that it's updated, that it is in place so that you have some of these things, such as drag along rights if you need them. And again, Sally talked about this quite a bit at the last presentation, but the purpose of the buy-sell agreement, aside from that, is to make sure that when you go into business with your partner, that if it turns out that somebody else ends up owning those shares, you don't necessarily want to be partners with that person. So the buy-sell agreement is going to give you the right to avoid them, to get out of that situation. Customer contracts. Many businesses are loose with these. They don't have written contracts. Purchase orders haven't ever been reviewed or looked at, things like that. So it's important, obviously, to a buyer, if your customer can walk away the day after the deal because you had a handshake deal, then that's going to be less appealing to a buyer. And I know Steve is going to touch on this also, but if you can diversify your customer base, you're going to be more valuable to the buyer. If you have one large customer who generates a significant portion of your revenue, that's going to be a riskier proposition to the buyer. And so the purchase price will be a little bit less, and the pool of buyers that you appeal to will be a little bit less. Insurance policies. So this can be liability insurance. You want to make sure that's all in place, but it could also be life insurance. Often companies have life insurance policies on key employees, and you want to look at how these are going to be treated in the sale, but also to make sure they're properly set up as far as how the premiums are paid currently, whether the ownership is set up properly, whether the beneficiary is set up properly. All of those should be looked at. And in most cases, the policy will be transferred out as part of the sale. The buyer doesn't typically want a policy on a former owner that's not engaged anymore. And as a former owner, you almost certainly don't want somebody that you have no involvement with having a life insurance policy on you. So that's another one to look at. So the next topic, general topic is financial hygiene. And so, and Steve's going to touch on some of these too, but from a little bit different perspective. So the financial statements, you need to review them, specifically look at the deductions and the salaries. You have some personal deductions in there. I know, of course, nobody ever does that in their corporations, runs anything that would be personal through the corporate accounts or tax returns. But just in case there is somebody out there that does that, you want to make sure that you clean that up, because that's going to look, from one thing, it's going to reduce your net income, and those are not real expenses that would stay if you had a new buyer. So you want to look at it from that standpoint. Also, how are the salaries treated? Most people, if they have C corporations, they're zeroing out most of the compensation at the end of the year in a closely held business or a family business, because they don't want to pay a double tax. They don't want to pay tax at the corporate level, and then again when they take it out as a dividend. So that's great while you're doing that, but when you look at the financial statements, there's not going to be a whole lot of income because you're zeroing it out with compensation. So that's another thing to look at. And then on an S corporation or pass-through, it's the other way. In a lot of cases in those entities, you'll take a lower salary so that you pay a little bit less in employment or Medicare taxes, and you'll take more of it as a distribution. And so that can also be misleading. So you sometimes we use the word normalize the financial statements, but sort of clean them up to make sure that what they look like when you're going to the buyer is the same as what they'll look like after the closing. And in most cases, they'll look better after the closing. And so you want to clean that up, and so you don't have to try to convince them of that through the due diligence process. Tax filings, we'll make sure your tax filings obviously are up to date. Buyers are spooked by people who haven't filed taxes for good reasons, because it might indicate some other things. And if you're in the middle of the audit, that could also spook people. So you'd like to get that resolved as soon as possible. Retirement plans, again, you want to make sure those are up to date and compliant. Some of those need to be updated at certain times on a regular basis. And then the structure of the entity for tax planning purposes. So if you have a C corporation and you sell assets, and most buyers prefer to purchase assets, you as a seller would prefer to sell the stock and just pay your capital gains tax and be done. But most buyers don't want that. Most buyers want to buy the assets of the company. And so if you are a C corporation and you sell assets, and then you receive cash at the corporate level and pay tax, and then you have to get the assets out of the corporation to you, you pay tax again. So it may be prudent, if you have time and if it works for other reasons, to change the status of your company. You may be able to change, for example, from a C corporation to an S corporation, which will save you possibly some money upon the sale of the company. So it's something certainly to look at. There may be reasons you can't do that depending on your company. It's not quite that simple, but it's possible, and it's certainly something worth looking at. If you are selling stock of a C corporation, they're going to look at that built-in tax. They're going to look at that when they're coming up with the purchase price, because they know that you have that corporate level tax. And so again, it's just something you want to take a look at. And the last part that I'm going to talk about on this standpoint is the estate tax planning piece of it. And again, this needs to be done in advance, at least a little bit in advance. But there's a lot of potential benefit. And again, if you're at the first webinar, they talked about this to some extent. You could spend several hours talking about these. So I'm just going to touch on a couple of highlights. One is, the first point is, Steve mentioned that it's a good time to sell. It was a good time to sell because the interest rates are so low and people can borrow money at these low interest rates. Well, the same is true from an estate tax planning standpoint. You can sell assets to a trust and take back a note that pays you 1% for 9 years. And those are historically low interest rates. So low interest rates help you from a planning standpoint tremendously. The second factor is that you have low values on some assets right now. This wasn't the case 4 or 5 months ago, but it is now. With the COVID-19, the values of some businesses are down significantly. Almost all real estate is down significantly. And I know, spoke to an appraiser last week, and they're building in what they're essentially calling a COVID-19 discount when they're valuing businesses. So low interest rates, low values, and then on top of that, we have a pretty high estate tax exemption right now. It's a little over 11.5 million per person, so over 23 million for a married couple. That's the highest it's ever been. It's supposed to go back to about half of that in 2026. Whether that happens, I don't know. Whether it happens before then, that's also a possibility. So between, again, those three things, low interest rates, low value, and a high estate tax exemption, all historical to some level, you've got a lot of opportunity. So I just briefly, the list of things that I put on there: gifting, you can give assets away. Again, you have low values and a lot of exemption to use. The installment sale is a sale of assets. Again, low values and extremely historically low interest rates from the IRS standpoint. So if you sell an asset to a trust and you sell it for a low value, you take back a note for 1%, you essentially freeze the value at that low value in your estate, and you're only getting 1% return. All the appreciation is going to the trust and the family members outside of your estate. Charitable planning, there are multiple methods of charitable planning. If you're inclined to do that, there are lots of opportunities. And if you are interested in doing that, you do that before the sale, you plan for that before the sale. You can get more to the charity because they get it tax-free. So again, lots of different ways to structure that, where you retain potentially an income stream or give the income stream to the charity. Lots of ways to do that. But if you're inclined in a charitable manner, it's something definitely worth looking at. And then the SLAT is just, that stands for a spousal limited access trust, and that's part of gifting. It's a way to gift assets out of your estate, but still allow your spouse access to that. So as long as you're married and alive, you both effectively have access to that. So just to finish up here, in planning for the sale, a couple of other topics. One is, you look at your retirement planning, meet with your financial advisor, get comfortable with what the sale is going to look like to you once you're finished. And are you going to have sufficient cash flow and assets to carry on and be comfortable? It's not going to determine the purchase price. The buyer doesn't care how much you need for your retirement, but from your standpoint, to get comfortable that it's time to sell and what price you're going to be comfortable with, it's important to sit down and cover that so you're comfortable with where you end up. And then lastly, and this is very important, and I've seen this many times, is the psychological aspect for many of you. Many business owners have spent their life building a business, and it is a large part of who they are. It's part of their identity. I would suggest lawyers are notorious for this. I know lawyers who worked into their 90s and never retired. I don't plan on doing that, but I know many who have. And so you have to consider that. What are you going to do with your free time? Do you have hobbies? If not, you might want to start some. And the other thing is to consider phasing out and slowing down before you sell, so you are not going from essentially 100 miles an hour to 0 miles an hour. That's very difficult for most people, and can be challenging, certainly from a psychological standpoint. So I'm going to turn it back over to Steve now, and he's going to talk about some more of these issues and drill down a little deeper in some of them.
Thanks, Scott. I want to echo one thing you did say, which is really important, and that is to make sure that you clean as many things up as you possibly can before you go to market, because private equity firms in particular, or financial buyers and strategic buyers, are really going to do a lot of due diligence. They're going to look under every rock, and they're going to look for ways to reduce the price, even though they may have agreed to pay a higher price in the letter of intent. So with that, when you go to market, I think one of the most important things you can do is develop a good team to assist you, and that probably starts with getting a very good quality investment banker. That does mean I want to diminish the value of good accounting help and good legal help, but I think they're critical if you're going to try to get the highest and best price. The other thing, sort of a soft issue, is build a good management team within your company. I mean, especially private equity firms, if they're buying a brand new platform company, they value very highly the skill level of your executives in your management team. They'll pay a lot more for a well-run, well-managed company than they will one where they have to come in and actually try to replace a lot of people. Because they really, for a private equity firm in particular, they're the key to running this company post-closing. Another thing that's critical, that Scott mentioned briefly, is making sure your executives, especially your CEOs, top salespeople, maybe have assignable non-competes. I worked on a deal 3 or 4 years ago where the seller lived in Florida. His CEO was critical to the company. The private equity firm buying the company wouldn't buy the company without getting him to sign a non-compete agreement and actually an employment contract with their company. And we spent more time negotiating a deal with him than we did the private equity firm. We ended up paying several $1 million to get him to sign a new non-compete. But had we had an old one that was signable, we'd have had a lot more leverage to really probably decrease what we paid him. As Scott mentioned, I think you want to resolve all your outstanding liabilities and contingencies. I think buyers look at things in a worst case scenario. If there's a lawsuit going on, they're going to reserve, a lot of dollars for that lawsuit. And, really, if you've got key assets, you really want to make sure that any issues relating to those are resolved. Give you a good example. We had a company 2 or 3 years ago we sold that had software developed by a non-employee. And when the private equity firm looked at all the agreements in the data room, they questioned whether or not the company actually owned the software, whether or not they just simply had basically a license to use it. It appeared to them that the software was owned by the developer. And that had a huge issue when you look at value in that company. And some very simple things you can do trying to improve profitability and growth, basically by both product line and customer diversification, which Scott alludes to is critical. We sold a company probably 5 years ago that had 2 customers, had over 50 million in revenues and had substantial EBITDA, and we were only able to get, I shouldn't say we, but the investment banker's best offer was 3.5 times EBITDA. Now, if that was a company that had no real customer concentration, it probably would have sold for twice that. So it gives you an idea of really how the marketplace values, and the worry that a buyer has if they lose one of those customers post-closing. Well, that company doesn't have really almost any value. So if you can do that, that's great. That's easier said than done in some instances. One of the things I want to talk a little bit about is what the buyers see and what they look for in financial statements, because that is going to be that's going to be the most important part of your company. I mean, as Scott alluded to, you want to make sure when you look at financial statements that you have seller add backs. You got to reduce the owner's salary and make sure you're kind of cleaning the financials up to reduce all the perks. But another really critical thing that I tell people is to minimize your working capital. When buyers purchase your company or purchase a company, they are going to want with their price a level of working capital to come along with that company. And what typically they do is they look at your past 12 months and say, oh, gee, if you're carrying $10 million of working capital, we need to get $10 million of working capital when we buy your company. And if there's less than that, we're going to reduce the price. If there's more than that, we'll pay you more. But a lot of companies carry excess working capital, and that's going to be the issue. So in theory, if you can decrease your working capital, maybe 6 to 12 months before you sell, you probably are going to save yourself millions of dollars, literally, because we've had companies that have carried, a tremendous amount of excess inventory. They've got a lot of excess working capital, and they're going to have to fight with a buyer over what's a reasonable amount of working capital when they go to sell that company. I can only tell you that buyers also love audited financial statements. So in theory, if you're going to market, it would be good to get audited financial statements. They're very trustworthy. And I've told buyers in recent times, or sellers, that they may actually consider getting what's called a quality of earnings report. And it's really an audit of your cash flow, to be honest. But it's really good to know if there's a defect or there's an issue or there's a problem. Typically, a quality of earnings report will pick that up. And I mean, that's critical going to market, because you want to know roughly what the value range is of your company. I mean, you don't want to be out in the marketplace hoping for a big price, having a shop worn deal and not being able to get the deal done. And the other thing that I think is critical is really know what your net is. Scott alluded to the fact that, what you get really isn't, I mean, it's critical, but the most important part is what you keep. And that's driven by a lot of different things, like how you allocate the purchase price to assets and a number of different things. So know going in what your gross price ought to be and what you think your net's going to be. And that partly, it dovetails into, looking at the structure and some of the key terms, because, there's all kinds of different ways to sell a company. You can sell the assets, which is great for most people, and most people want to sell assets, and most buyers want to purchase assets because they can actually get a large tax deduction. They can effectively amortize or deduct the entire price. Now, if they buy stock, they can't amortize or deduct the portion of the price allocated to stock. And Scott mentioned, I mean, there are things that you can do to eliminate what I would call the built-in gain or double tax. If you're selling assets in a C Corp, like making allocations to personal goodwill, non-compete agreements, you can embed a deferred comp plan within that C Corp, so that effectively when you sell, that deferred comp plan pays out what is an effective deductible salary to the owners, which reduces the gain. But I think it's really important to take a look when you go out to market, what form of sale you're going to look at conducting, and if it is an asset sale, how you're going to allocate the purchase price. And there are other options. You can sell the ESOPs, which have certain tax benefits for both buyers and sellers, depending on what type of entity you are, and tax-free organizations, which generally, if you're dealing with a public company, is fairly common. They sometimes will give you the option of effectively selling your company or trading your stock in the company for stock in that public company. So, and again, that's tax-free until you liquidate the stock you've received in the sale. One of the other things that, I could spend actually 5 hours talking about is residency issues. We've had a lot of issues with our sellers looking at it and saying, well, gee, I'm selling this company for 50, 60, 70 million dollars. In Minnesota, you're going to pay roughly a 10% tax, state tax, on the entire gain. So people have said, that can be a significant amount of money, and I would love to save that money if I could. Well, people have then said, well, what about if I go set up a residency in one of the tax-free zones such as Florida, South Dakota, Texas, I think Washington, Nevada are the only tax-free zones I can think of off the top of my head. But the idea would be that they would go down and set up a residency in one of those states, and when they generate that $50 million of gain on the sale of assets or stock, they will not have to pay any state income tax. And it's a great deal. I can only tell you in Minnesota, that has become the #1 income tax audit issue. And it's very, very, you've got to do a lot of planning to actually change your residency. In Minnesota, you can be deemed a Minnesota resident if you spend more than half of your time in the state, 183 days, or you become what's called an intent resident, where they look at 26 factors and they say, well, where do you vote? Where do you go to church? Where's your driver's license? How much time do you spend in this state versus Minnesota? They look at 26 factors, and they can make you a resident or try to make you a resident, even though you've been out of the state more than basically 6 months. So, and one other variation on theme is that generally, if you're selling stock, basically the gain will be taxed in the state that you are domiciled in. Well, if you're selling the assets of a company, for example, that's only operating in Minnesota, you're still going to have to pay state income tax on that asset sale in Minnesota. So, but if you could get a buyer to purchase stock, you could avoid paying any state income tax on that transaction. So that being said, I alluded to initially that timing is critical, and there's a debate now whether today or this year or even next year will be a good time to sell. And what happens if a decision is made that you're not going to sell? This timing isn't right. Well, I think buyers right now and sellers are starting to think about that very carefully. And with respect to sellers, there is a risk. If you sell, good example would be if you walked into my office, which does happen a couple times a year, where people say, hey, got a great offer. I've got a company I'm going to sell. The price is $6 million. And the seller is 62 years old. That person is probably living on $1 million of pre-tax income. So they're big spenders. They've got a lot of money generated every year, but when they sell that company and they collect their $6 million, well, they're going to pay tax on that. They're probably going to pay a few debts off, and they're probably going to be left with somewhere in the neighborhood of $4 million. And they're going to go to their investment advisor and say, wait, what kind of return can you get me? And I've kind of alluded to the fact they probably will get 4% unless they want to take a lot of risk. And that investment advisor is going to say, you probably, you're 62, you and your wife, based on the chart, you and your wife stand a good chance, or you and your husband stand a good chance of one of you at least living to be 90 years old. So that money's got to go a long way. So can you live on 150, maybe 160 grand a year plus Social Security and some other savings that you have. And a lot of people have said no. I mean, I've spent, I mean, my life savings are wrapped up in that company. And if that's the case, if you can't reduce your budget to that point, well, you know, you've got to hang on to that company, try to build it up and sell it at a later point where your longevity may not be that long. So a lot of sellers have thought that through, and actually a few or number are doing it, but they want to grow their company. And they've developed incentive plans to help their company or help get their company some growth. In fact, I've got a company that a few years ago, they hired 4 key people. In fact, one to replace the individual that was a CEO, and they had hoped that these individuals could grow the company to, you know, from basically being worth maybe $50 million to 200 or 300 million. And they told the executives that, look, if you can accomplish what we think you can accomplish, we will give you stock flavored rights. We'll give you a stock appreciation right where if you grow the company, we'll give you 10 or 15% of all the appreciation. So they found ways to incentivize some key people to grow the company. And assuming it works, I mean, you know, in 3, 4, 5 years, they'll have a company worth, you know, 2 to 3 times what it's worth today. And they will be sharing on some of the, you know, the net revenue off that, or the net gain off that company. But for them, it's a great deal. So, I mean, I think there are some alternatives if timing isn't right. But again, I think you've got to be pretty careful. So with that, we'll open it up to any questions that people might have.
Steve, I don't see any questions in the chat room. If anybody has any questions, feel free to contact Steve or me or any of your other attorneys at Lathrop GPM, and just like to thank everybody for attending.
Thanks very much.